This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we will dig into the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we look at challenges facing Intel as competition heats up. Plus, is climate change becoming a significant driver of economic activity in the U.S.? But first, rising wheat prices are forcing European packaged goods makers to make tough choices, even though prices are 45% below their peak. For more, we're joined by Bloomberg Intelligence Senior Consumer Products Analyst Duncan Fox. So, Duncan, I think everybody's been following, obviously, what's been happening in the Ukraine. And just frame out for us what it means for the wheat market that is so crucial for a lot of the packaged goods manufacturers that make the stuff we eat.
Well, I suppose the key thing is that Russia and Ukraine were something like 30% of the global exports, but they're still 27% now, but that's mainly Russia, and obviously, 22% of that is Russia. So most people have got sanctions, therefore, in the European countries, so you would have to get your wheat, if you're importing it, from other routes, and therefore it's going to be a little bit more expensive. So it just makes life a little bit tougher. Yes, they did a very good job last year at getting around it, but they've got to do exactly the same again this year.
So talk to us about kind of what it means for the packaged goods companies in terms of their ability to pass along price increases versus, just taking a hit to their profit margins.
Well, that's going to be a lot more difficult this year than last year. Everybody recognised that there was global inflation going on, and pricing, actually, they got it probably 4 or 5 times last year, which is very, very unusual. You normally get it once a year. So if you have to cover what you need at the current prices, which are pretty high now, I'm guessing most companies didn't hedge last year when they spiked up to 1,400 on the generic wheat, and they'll have 3-year rolling hedges, so they're probably been hedging at the sort of, 600 to 750 area, which they are now. But at some point they'll have to pass that on. So they'll have a bit of time, probably 6-12 months to negotiate any pricing. But we've seen politicians getting involved in Europe, UK, making sure that food prices stay low. So they may just have to take some of this on the chin and take a margin hit.
Well, we've seen, at least in certain parts of the world, yields and production have been kind of record highs. Is that kind of making up for the lost supply coming out of Russia and Ukraine?
Yes, it's interesting. The farmers did a phenomenal job last year, despite what's going on. We had a La Nina, which is normally not brilliant. That's finished now, and then into an El Nino. But yeah, global production's at a high. Wheat yields are at a high. So there's no real problem in the short term, because there's about a third of what we consume in a year as buffer stocks as well. So it's really just negotiating when you buy the product, cover off your needs and make sure you can push that through to pricing, when it's going to get considerably more difficult to do that as we get into the second half of this year.
So is the right now, I'm just looking at a great chart you had there about generic wheat prices, and boy, they've just spiked to, as you mentioned, $1,400 back during the beginning of the war in Ukraine. What's the expectation on the part of the companies as they look out to 24 and beyond?
I think they were expecting it to sort of calm down. I mean, the previous range for probably, 10 years was $400 to $600 for the generic. Now, it'll depend on what quality of wheat you're buying, but I was thinking that the 600 would have probably been the bottom of whatever the new range is. Seems to happen every 10 or 15 years. You get a jump in the range. Where the top's going to be is going to depend on if anything else happens in the Black Sea, really, whether ships start to be sunk, or whether they take out more ports that are part of the Ukrainian ports, that could just cause some short-term supply issues. But on the whole, I would think somewhere in that 600 to 800 range is where we'll end up. And therefore the companies will have to work out what they've got hedged out already and work it out, obviously, on that 3-year rolling plan that they have. Problem is they're coming off probably getting rid of wheat at about somewhere in the 400, 500 range. So that's the problem they've got to pass through to us at some point over the next year or so.
And just real quick, Duncan, is the assumption that Russian wheat is just out of the marketplace for the foreseeable future?
Well, it is for the European companies. In the global market, then the countries that haven't sanctioned Russia will be getting that wheat at whatever the price is in the market. So they're probably quite an expensive level at this current time. But
right.
You've got to feed your consumers in each country. So that's what you'll do.
All right, Duncan. Thanks so much for that. We appreciate it. Our thanks to Bloomberg Intelligence Senior Consumer Products Analyst Duncan Fox. Let's turn now to climate change, which is driving around $500 billion of economic activity in the U.S. To tell us more about this, as well as the findings of the BI Climate Damages Tracker, we're joined by Bloomberg Intelligence Senior ESG Climate Analyst Andrew John Stevenson. So, Andrew, let's start with that. What is the BI Climate Damages Tracker?
Sure. So we basically are keeping score. So you've seen event after event, damage after damage from climate change. It looks sort of scattered and inconsistent, but if you look at it over time, and especially if you look at it, you're talking about floods, you're talking about wildfires, you're talking about storms. These things are impacting the economy and obviously impacting people pretty seriously this year, if you include things like the wildfires as well with the smoke that we're seeing. So this is really a way of quantifying that, and what we're doing is quantifying it at the state level so you can understand how climate change is affecting not you in 2050 or 2100, but today. And it's expressed as a percentage of the state GDP. So you can understand it in terms of the property damages that you're seeing, the cost of power outages, how, if you think about what happened to Texas a couple of years ago, the entire state was frozen over for a week. In a $2.7 trillion economy, that's a lot of lost economic activity.
All right, so
what includes government spending and power outages and things like that.
It's really fascinating because it's become obviously such a huge story, just climate change and the impact. So what are some of the conclusions or takeaways you've had from, looking at this data in detail?
Sure. So, if you think about the title, $500 billion is a lot of money, right? And that's really what's happening is you're seeing a wealth transfer within the economy. The vast majority of us are losing. We're having to pay more to replace, our roofs or fix flood damages in our homes. For businesses, their insurance premiums are going up, et cetera. But that economy, that income or money is being recycled within the economy. So there are both winners and losers from an economic standpoint with respect to climate change. And the idea is really to try to track these damages and understand it in the context of, for those that are the Home Depots of the world, where people have to go out and buy extra, things to repair and replace what has happened to their homes. This is an economic driver, but for the rest of us, it's a pretty significant headwind, and it's coming at the cost of other things that you'd like to spend your money on.
Does this tracker show that, in fact, damages are going up in absolute dollars and I guess as a percentage of GDP? Is that, in fact, what the data shows?
Yes. Yeah. It moves up and down with the events. But if you think about, a storm we saw in Florida, and I just moved up from Florida in January, we saw a massive storm. Hurricane Ian came through, and, that was about 10% of Florida GDP that went to try to repair the damages from that storm. So you're seeing it's a very significant amount of the Florida economy that's being devoted to, kind of picking up after that storm. And then, there's an entire industry that's focused on preparing for the next one. If you think about Aon or some of the companies on the data side that are trying to help us better understand what these climate events mean economically to property, to businesses, et cetera.
So I'm just, again, looking at your research report here, and you have a note here that damage is likely far higher than the BI estimate. Why is that, and how did you come to that conclusion?
Sure. So we track about $7 trillion worth of damages that have been that the U.S. economy has been hit with over the last, from 1990 to today. But we aren't including everything. There's quite a bit of things that are happening in the economy that we are not able to quantify as easily. But we're also not including things like higher insurance premiums, healthcare costs. These things, when you all add them up, the estimates just for the wildfire smoke is about $150 billion a year in terms of lost wages. These are things that we hope to tackle in the future, but we really need, better peer-reviewed research and better data to make sure that these are, kind of strong numbers that we can support and put on the terminal.
Fascinating stuff. Really great work there. Our thanks to Bloomberg Intelligence Senior ESG Climate Analyst Andrew John Stevenson. Coming up on the program, is it time for PepsiCo to rev up its snack market push? You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Consumer snacking is powering a roughly $169 billion market in North America, something that PepsiCo is poised to grab more of soon. To discuss, let's bring in Bloomberg Intelligence Senior Beverages, Tobacco, and Cannabis Analyst, Ken Shea. So, Ken, talk to us about just the snacking business today. What does it really include in that $160 billion market?
Yeah, hi, Paul. So the snacking industry in North America or the U.S., whichever you want to take a look at, is, it's large. As you said, $169 billion North America. It's mostly the salty, savory snacks that many consumers can relate to. It's the Dorito chips. It's the Lay's potato chips. Sun chips, but it's broader than that as well. It also includes, things like snack bars and cookies and even nuts and seeds. And it all basically addresses consumer desire for a salt and sweet snack on the go. It's convenient. It's perceived to be, in many cases, healthy. And this is the space that PepsiCo has done a really great job in over the years.
All right. So what are the big competitors outside of the PepsiCo, which is, the Frito-Lay brands and all that?
PepsiCo really dominates the salty aisle. Depending on how you measure it, if it's just salty, it's like 60-something% in the U.S. It's really dominant. But if you broaden that category beyond and say it's savory treats like Triscuits and things like that, then you're talking about competitors like Pepperidge Farm, which is owned by Campbell Soup, Kellogg, which has Pringles, the Pringles franchise, Mondelez has the Triscuits and Nabisco products, and so on. But my point with the research over BI the other day was that as dominant as PepsiCo is, some 39% share of that big market that we mentioned before, it can even do better. And this comes off a second quarter where sales are up like 15%. I mean, that's just phenomenal for a food company or a snack company.
Right.
For any company. But we think that there's some aisles that it can compete in and put its competitive advantages, like its vast distribution channel, its marketing savvy, its finances, all these things to really flex its muscle right now. It can even do better, we think.
Do they do better by better promoting what they already have, or do they go out and acquire different products in these other subcategories in the snack market?
By and large, PepsiCo has grown organically. It's so big that they know they would run afoul of some regulator
right.
Pushback if it was to grow where it's already at. But, it's such a great marketer and knows its customers well. And it's willing to spend heavily on its direct-to-store delivery system. And what that simply means is it's willing to invest in the trucks and the people and to go into the store itself and manage the aisle for the operator. That's a big advantage over the competitors it has, who by and large ask them to go to the warehouse and, pick up the pallet and things like that. I mean, so what you don't see very often when you go and buy a Pepsi product or Frito-Lay product is an out of stock because it's right on top of it. It has a salesman go in there, and retailers love that, and that gives them a big advantage, having that strong relationship with the retailer that it can leverage more than its competitors can.
So I'm looking at your research here in the U.S. snack market leaders. PepsiCo, as you pointed out, in the savory salty snacks is dominant, number one. But in the snack bars, which seems to be a pretty big category, they only have a 5% share. What do they do there? What's their strategy there?
Okay, so that's basically their Quaker, convenience bars and things like that. We think they can do better, and that's one of the markets that I mentioned. I mean, think about some of the competitors, General Mills, Mondelez, Kellogg. These are all companies that it knows pretty well. These are companies that also understand they're good stewards of a category, meaning they don't tend to get in a lot of price competition. They understand the notion of passing along commodity costs into pricing. It's a good category. It's got good margins, good growth. It's completely in the area that Pepsi wants to compete in. Again, a convenient food product that's perceived to be healthy. My point is that PepsiCo should be playing there much more aggressively, and we think it can do that by just growing and leveraging some of its existing brands. Why should Cheetos and Lay's be happy to just be a salty, savory flavor? I think it can extend beyond that. Why not go to the salty / sweet category, or even the sweet category itself, to get into there more meaningfully? You got to remember, these products are sold in the same places that its existing snacks are. So where you see a Cheetos, you also see nearby snack bars. So there's no reason that Pepsi can't distribute to those same channels.
What has been the challenge to date? Is it just simply the other players have a stronger position?
Well, it's a good question. I think PepsiCo is just so focused on what it's doing, and it's doing it so well. It's easy for me to say they should be doing things. I mean, they know the business better than I do, but I'm just saying this seems to be a logical place where they want to move. And the reason I'm saying it now is because they're starting to do that in some other aisles. They've leveraged the Cheetos name in the mac and cheese aisle. They've moved in a small way. Captain Crunch it owns to Quaker.
Yeah.
Into the cereal bar category. So you're seeing some of this going on, but I think they can keep the momentum going and reduce its dependency on the salty snack dominance that it has by broadening and expanding the number of growth platforms that it has.
Where is Pepsi and some of its packaged goods peers in terms of dealing with the inflation in their raw materials and passing along to customers? Because we have inflation coming down. How is it impacting those companies?
Well, I can't speak for all of them, but in terms of Pepsi, they've done a good job in passing along the cost increases that it's had. As a matter of fact, the last call a couple weeks ago, they noted that they pretty much passed all the costs along in the quarter, and they were able to expand the margins by the reinvestment in the productivity tools like digitalization, automation. This is a manufacturer, and they have always room to do things a little more efficiently, and they seem to figure out a way to eke out more efficiency every quarter, it appears. Now, again, that's not true for every company, but this one is such a well-oiled machine, which is why, getting back to my original assertion, that they can put that into other categories. But you're right, though. In the second half, we're going to see price increases coming down. And the company even said that. They said, at some point, consumers, there could be, a backlash that hasn't been yet, but it's reasonable to think at some point, consumers don't want to see sticker shock, for extended periods of time, but they can do it because costs are coming down from the inflation front. And so we think that the company will be able to maintain share in the second half.
Pepsi's been around forever. I'm guessing they're in markets they want to be in on a global basis. Are there any areas of the globe that they call out as potential areas for investment and growth?
They've cited a lot of the emerging markets, like many other companies have, India, Asia, and so on. But they don't have the infrastructure. I mean, they need partners in many cases to grow there. Not that there's not opportunity. There certainly is. They do very well in Latin America. But I think PepsiCo sees itself as a global powerhouse, and it would like to leverage its strengths already in a lot of these markets. So there's no one in particular, but I would say the emerging markets like India, China, Southeast Asia certainly have to rank high in terms of what it sees long-term as a growth opportunity.
What's probably the big challenge ahead of PepsiCo right now? Is it just simply the global economy, or is there some headwinds that are unique to Pepsi?
I wouldn't say there's anything unique to Pepsi there. I mean, the dollar strength seems to be working in their favor the last few weeks anyway. I would say maybe a greater scale on the beverage side. People like to compare them to Coca-Cola. I don't think it's fair because Coca is more of a carbonated beverage centric company. Yep. That Pepsi's more of a full beverage organization. But PepsiCo doesn't really have the infrastructure outside the U.S. to the extent that Coca-Cola does. So there's a little weakness, I would say, by not having that infrastructure outside the U.S. It lends itself more dependent on other companies to help it grow.
Yep. That's a great deep dive on our good friends at Pepsi. Our thanks to Bloomberg Intelligence senior beverages, tobacco, cannabis analyst Ken Shea. Coming up on the program, we'll talk Berkshire's lean into the Florida reinsurance market. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. Berkshire Hathaway's lean into the Florida reinsurance market makes its earnings more vulnerable to a large hurricane than any other insurer, with up to $15 billion at risk. For more, we're pleased to welcome Bloomberg Intelligence senior property and casualty insurance analyst Matthew Palazzola. All right, Matthew, Warren Buffett, he knows what he's doing in this insurance business. Why is he going into Florida?
So Warren Buffett knows what he's doing, but more so Ajit Jain knows more than probably anybody in this market what he's doing. So the reinsurance market, which we've talked about many times, is insurance for insurance companies. And there's been trouble in that market. There's been a lot of large losses, as we've also been talking about, a lot of huge weather events, coupled with a lot of fraud in Florida and kind of anti-insurer regulation in these coastal states. That has led to reinsurance companies pulling away from the market. So you had an increase in demand and a decrease in supply. So what that means is prices went up dramatically. There are certain times in the year where reinsurance renews. That's one of them is January. At January 1st, Berkshire didn't really write as much reinsurance premium as the market thought they were going to. And everyone kind of stepped back and said, what's going on? What's Ajit thinking? Then at their annual meeting, they announced, at 4/1, we leaned heavily into Florida, which was seeing the best prices.
All right, so this is a risk-reward game. Mm-hmm. And so obviously the folks at Berkshire are saying the pricing is good enough there that it compensates us for the risk. Do you think that's, A, is that a fair read, and B, is that a good read?
That is a fair read. I wouldn't disagree with Ajit. You know, he's a lot more successful than I've ever been in the insurance business. You know, he has said we have $15 billion at risk, and they stand to make maybe single-digit billion. I think that 15 is a far-out number. It's probably not going to happen. You probably need a massive hurricane for something like that to happen, and for them to make several billion. You know, it's a risk-reward business. That's what they do. They think the risk-adjusted returns are good.
What does the market think?
Berkshire stock has done well. Okay. Berkshire, as you know, is a different beast. You know, I don't know how much this plays into the stock doing well besides other things. I think Berkshire's stock performance has been a little counterintuitive. I thought things were going perhaps the other way for all their other businesses, and the stock keeps going up. So I guess the market likes it.
All right, so talk to us about the Florida market here as we're right smack in the middle of another hurricane season. Is there a long-term solution for better insuring the good folks down in Florida? I mean, so many people are moving there now. It seems like everybody and their brother is moving to Florida. Is there a longer-term, more permanent solution for the insurance and the reinsurance in that state?
Yep. So I'm cautiously optimistic. I think the market is as well. So what was happening there is there was a lot of laws put in place that were meant to protect the consumer. And what happened is they got abused. So these aren't exact numbers, but I had heard about a roof claim. Maybe that cost $20,000 to $30,000. It could have cost these insurance companies upwards of $100,000 to $150,000 because of all the fraud and litigation that went into these claims. The state has taken steps to reduce this. Now, what's going to happen though is we need a test of the market, right? So there's smaller things happening, but you need an event to come through to say, are these contractors still doing this stuff? Will these claims last for 3 years like they have been? So we can't say yes or no, but we're saying I think Florida took some good steps. The reinsurance, what was happening last year is you couldn't even get reinsurance. Now you can get it. It's way more expensive, but you can get it. So the market has, I think, passively said, look, we think this will help. So we just need a test, and we'll see what happens.
A test being like a hurricane.
It doesn't need to be major, but a hurricane come through of some size. Small events, they can't really tell. So if you got a $5 billion or $10 billion hurricane that comes through, and then you still need time after that to see how the claims develop, then that builds faith in the market.
So, I don't know, you drive along Palm Beach or down in, South Miami Beach, and you see these monster estates. I mean, these are $20, $30, $40 billion homes. Are they insured?
I would think so. I can't exactly say. Maybe one day I'll find out. I don't know. But, a name that does that is Chubb. AIG does some of that business. I don't know how much they've leaned into Florida, but maybe if you've got a $30 million house, you don't have insurance on it. I actually don't have a great answer for that. That's not what's causing the big losses, right? The big losses are just coming from the run-of-the-mill aggregation of all homes. And what happens in these, wildfire prone places and hurricane places they are nice houses. They don't have to be 30. They could be, $1 or $2 million. And a bunch of those is a big deal.
Right. All right. So interest rates, I don't know, they're still pretty high. It looks like we're going to stay higher for a while. What's that mean for the insurance companies?
So that's good for the insurance companies, right? What's happening generally is underwriting results are good. I struggle to see them getting a lot better from here. So the lever for these guys to have better ROEs is interest rates. Next year or the year after, they might hit peak ROEs for this pricing cycle, and their valuations typically peak before those ROEs. So, there's probably room there. If we get another raise in interest rates, it keeps pushing out ROEs for these guys because they earn the interest rates in over time. They have big portfolios. They turn over about 10 to 20% a year.
So still, how are these stocks performing?
They've been a little bit better. They underperformed in the beginning of the year when we're kind of on this tech buy kind of risk on scenario. If that flips, they'll do a lot better. Market fear would be good for these guys, the defensive names. So they're kind of, aside from earnings events, they're generally at the whim of the macro.
All right. And so as we sit here in kind of late July, what's the expectation for the remainder of the hurricane season? We haven't really had much.
No. So the season started off strong. We've had these countervailing effects. So we had the El Nino effect, which generally suppresses hurricane activity, but then we had high sea surface temperatures, which feed hurricane activity. That led to the people who know these things to call for about an average hurricane season. They upgraded that to above average. Since that point, though, a couple of weeks ago, we haven't had much formation,
right,
but
okay.
Anything can happen.
Anything can happen. All right. Our thanks to Bloomberg Intelligence Senior P&C Insurance Analyst Matthew Palazzola. All right, let's turn now to this tech space where Intel faces tough competition in its core PC and data center segments. For more, let's welcome Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani. All right, Kunjan, talk to us about the chip space now. Where are we in terms of the cycle? Because I've been told by chip analysts for a long time that these things have long cycles. So where are we in the cycle right now?
Yeah, so for the more cyclical sort of end markets like the PCs, the consumer, the smartphones, it seems what most people are expecting is the first half of 2023 should be a bottom. Of course, we can only confirm once we start coming out of the bottom. So everyone's looking into the 3Q and the 4Q guides coming into this earnings season. And it would be concerning if we don't see positive optimism from the chip companies that a recovery is happening. So that's where we are in the cycle.
Remind us all here, how long are these cycles typically in the chip business?
Look, no two cycles are same. And what we have seen in the last decade, that the chip business is becoming much more secular, given long-term tailwinds. So the cycles are becoming longer. What I mean is the peaks are staying there for a long time, and the up part of the cycle is staying there for a longer time, and the bottoms are much more shorter in terms of time duration. For example, we started seeing PCs bottom in 2022, and towards the end of 2022, like smartphones coming down. And the earlier expectation is by end of 2023, we'll start seeing the recovery. So I guess the bottom would last about a year or less than a year. But when we start seeing an up cycle, it stays there for a long time.
So that sounds good news for chip investors. Talk to us about the competitive landscape here. Let's start with kind of Intel. Where are they in the market? Kind of what are their strengths and weaknesses relative to their peers?
Yeah, so I mean, look, they have been facing some tough time for the past couple of years. From a competitive perspective, they are under attack from all ends, right? Like AMD, their typical chip competitor, is taking share away, specifically in data center quite a bit. They are in competition with their own customers. Their largest customers are designing their own chip solutions, like Apple did with the M processors, like Amazon did with their Graviton chip. So they are taking sort of that share away from Intel by replacing them with their own solutions. And then you have this new threat from an ARM-based architecture providers like Ampere Computing, right, who are trying to play in this market as well. So, and Qualcomm has announced their Nuvia ARM-based chip, which is coming out again, attacking the PC space. So, basically, from all angles that you can think of, their dominance is coming under attack.
Is there an AI play for Intel?
I mean, there's an AI play for CPU processors in server. So, and the only two, well, I should not say only, the two major players are Intel and AMD. So, yes, in theory, I mean, they both are exposed to the AI tailwinds, yes. Now, again, right now, AMD has the most high core count, high performance solution, which is what is typically preferred for high-end AI computing. So that's where AMD is getting a lot more exposure with the AI tailwinds. But remember, after training, which what most of the AI applications do right now, will come inference. And so there is definitely scope for Intel to participate in the inference run of that AI journey.
All right, I'd love to get your view, Kunjan, just kind of on the overall AI play in the marketplace. It feels like it came out of nowhere for most investors, really highlighted by NVIDIA's raise of their guidance last quarter. Help us frame out kind of what is AI to you? How big is this market now? And what kind of growth does it represent for the tech space?
It's a pretty broad question, but I mean, look, the frenzy that came out was driven by this launch of the ChatGPT by OpenAI, right? Which kind of exposed that you can build generative AI applications using these large language models. And currently, the primary vehicle to build these are GPUs, and hence NVIDIA seeing most of the benefit right now. In terms of how big this market is, I mean, it's in a very early innings, varied of numbers being thrown out by industry analysts and Wall Street. NVIDIA has claimed their TAM now with this generative AI is about $1 trillion. A lot of that is software, although. So in terms of growth, I mean, I think, like I said, we are in the very early innings, so we should see significant growth, at least for the next foreseeable future.
I'm looking at again, not being a chip guy per se, I'm looking at, obviously, NVIDIA has been the big win here from the AI mania, if you will, up over 200% year to date. But I see Advanced Micro Devices, I see Broadcom, each up 60, 70% year to date. So it looks like investors are trying to find other ways to play AI. From your perspective, in your chip space, I mean, aside from NVIDIA, where do you usually point people?
Exactly to the names you mentioned, and there's a reason. So when we think of an AI server, yes, the core starts from a very high-end GPU. But again, that's the heart of it. You still need the peripherals, right? So you need still the highest performing server CPUs. That's where AMD comes in. You need AI high-performing networking to support that. So that's where someone like a Broadcom comes in. So people are trying to find, okay, beyond just the GPU, if they missed sort of the NVIDIA train, where do you get? So they're trying to go to the rest of the chips that get used in the AI server, even though they might not take the entire wallet share, but who are the next chips? So I point them to, again, the CPUs, the memory needed for these servers, and the AI networking chips that are needed for these servers.
So your space, the chip space, was really one of the poster children, if you will, for supply chain headaches and challenges that really became exacerbated during the pandemic. Where is the chip industry now in terms of supplying all of its customers around the world?
Yes, we kind of have gone on a very fast, accelerated path from being supply constrained and too much demand. Now, like I said, in the most consumer-exposed markets, there is just too much supply and not enough demand, right? So that's where we are for the majority, I guess, of the portion of the semiconductor industry. Although there are some small sections like AI, where we are now again in a supply constrained environment because, again, a lot of demand which was not expected end of last year just came on this year. So NVIDIA right now cannot fulfill all the demand it has. And these are, again, new chips at the leading edge nodes where all the supply has been constrained. So for the most part, like PCs and smartphone and consumers and industrials, we have enough supply, but some portions of like the AI where we are lacking in supply right now.
All right, Kunjan, thanks so much for that. We appreciate getting a few minutes of your time. Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.